You wake up every morning, go to work, and hand over a chunk of everything you earn before you even see it. And here is the thing most people never stop to ask. Why does the system work exactly this way? Who designed these rules? Because the tax code did not write itself. Someone built it. And they did not build it for you. They built it for themselves. Today, we are pulling back the curtain on how the tax system is fundamentally structured to extract wealth from working people while the wealthy keep more of theirs. And once you see this, you cannot unsee it. Let us start with the most basic thing that almost nobody talks about. The tax system does not treat all income equally. It never has. If you go to work and trade your time for a paycheck, your income gets taxed at ordinary income rates. Depending on how much you earn, that can go all the way up to 37% at the federal level. Now here is where it gets interesting. If you are wealthy enough to make your money from investments, from stocks appreciating in value, from dividends rolling in, from assets you hold, the maximum tax rate on that kind of income tops out at 20% for long-term capital gains. In most cases, it is even lower than that. 0% for lower earners, 15% for middle earners. Think about that for a second. The doctor working 80-hour weeks, the nurse pulling double shifts, the teacher staying late every night, all of them pay higher rates on their income than a billionaire who made millions simply because they owned the right assets. That is not an accident. That is design. Warren Buffett, one of the wealthiest people on the planet, famously pointed out that he pays a lower effective tax rate than his secretary. He said it publicly. He put it on the record, and nothing changed. Because the people who would need to change it are the same people who benefit from it staying exactly as it is. Now let us talk about deductions, because this is where the gap really opens up, and most people have no idea how deep it goes. The tax code is full of deductions, credits, and loopholes, and theoretically, anyone can take advantage of them. But in practice, they overwhelmingly benefit people who already have money. Here's a simple example. Mortgage interest deduction. You can deduct the interest you pay on your home loan. Sounds great. But think about who benefits most from this. Someone with a bigger, more expensive mortgage deducts more interest and saves more on their taxes. The person renting a small apartment, struggling to save up a down payment, gets nothing. The wealthier you are, the more house you can buy, the bigger the deduction, the bigger the tax break. The system literally rewards you for already having more. Business owners get to write off enormous categories of expenses that regular employees simply cannot touch. Office space, equipment, travel, meals, vehicles, health insurance premiums, retirement contributions. A business owner structures their life through their business and legally reduces their taxable income dramatically. A salaried worker gets none of that. They pay full taxes on every dollar before they can spend a single cent. And here is the thing that makes this so infuriating. None of this is secret. It is all right there in the tax code. It is legal. But the average person does not have an accountant hunting for every available write-off, and they do not have the assets or the business structure to take advantage of most of them, even if they wanted to. Step back and look at payroll taxes, because this is one of the most overlooked wealth transfers in the entire system. Social Security tax applies to wages up to a certain income cap. Once your earnings exceed that threshold, you stop paying it for the year. This means someone making $50,000 a year pays Social Security taxes on 100% of their income. Someone making $500,000 a year, they hit that cap early and stop contributing for most of the year. As a percentage of total income, lower and middle wage workers contribute a far larger share to Social Security than high earners do. The system is literally regressive at the payroll level. The less you make, the heavier the relative burden. And then there is the estate tax, or more accurately, the way it has been systematically defanged over decades. The idea behind the estate tax was simple: prevent the permanent concentration of dynastic wealth across generations. Tax large inheritances so that wealth cycles back somewhat into the broader economy. The exemption thresholds have been raised so dramatically that today only a tiny fraction of estates are subject to any federal estate tax at all. Wealthy families use trusts, gifting strategies, and other legal vehicles to transfer enormous amounts of wealth across generations with minimal tax consequences. Meanwhile, when a middle-class family inherits a modest sum, the bureaucratic and tax complexity relative to the size of the inheritance hits them proportionally much harder. Here is a strategy the ultra-wealthy use called buy, borrow, die, and it is exactly as wild as it sounds. Instead of selling appreciated assets and paying capital gains taxes, wealthy individuals borrow against those assets. Loans are not taxable income, so they access the cash value of their wealth without ever triggering a taxable event. They live on the borrowed money. The assets keep appreciating, and when they eventually die, the assets transfer to heirs at what is called a stepped-up basis, meaning the capital gains that accumulated over a lifetime essentially evaporate for tax purposes. Generations of wealth, built and transferred, with capital gains taxes never paid at any point in the chain. This is entirely legal. This is how it works for people at the very top. Now let us talk about why this never gets fixed, because that is the question that really matters. The tax code is not static. Congress changes it regularly. Lobbyists representing corporations and wealthy interests spend hundreds of millions of dollars every election cycle, ensuring that when changes happen, they mostly happen in their favor. The 2017 tax cuts reduced the corporate tax rate from 35% down to 21%. The top individual rates also came down. The benefits flowed primarily upward. Corporations use the extra cash for stock buybacks, which benefit shareholders directly, and shareholders are disproportionately wealthy people and institutions. Working people got modest temporary individual cuts, while the corporate cuts were made permanent. The temporary nature of the individual cuts was not a coincidence. It was a structural choice that ensured future political battles would center around extending or expiring the cuts, rather than fundamentally rethinking who the system serves. You stay distracted, debating whether your small cut gets extended, while the structural advantages for the wealthy keep compounding quietly in the background. There is also something deeply psychological happening here. The complexity of the tax code is itself a weapon. When something is incomprehensible, people disengage. They hand it off to a tax preparer, file their returns, accept whatever refund comes back, and assume the system is probably fair or at least too complicated to fight. That complexity does not serve you. It serves the interests that can afford teams of specialists to navigate every corner of it and find every available advantage. Compare this to systems in other countries where taxes are pre-filled and simplified for most workers. Their governments already have most of the information. They send you a form, you confirm it, you are done. The reason the United States does not have that system, despite the technology existing, and the IRS actually piloting versions of it, is not technical. It is political. The tax preparation industry, worth billions of dollars, has lobbied aggressively for decades to prevent the government from offering free, simplified filing to workers who would otherwise easily qualify. The complexity is maintained deliberately because complexity is profitable for the people monetizing your confusion. So what can you actually do with this information? Because outrage is useful, but only if it moves into action. First, understand that the tax code does reward certain choices, and some of those choices are accessible to regular people. Contributing to tax-advantaged retirement accounts like a 401k or an IRA reduces your taxable income right now. Health savings accounts work similarly. If you have any side income or freelance work, educate yourself on legitimate business deductions you may be entitled to. These are not cheats. They are the same tools wealthier people use scaled to where you are. Second, push back on the idea that this is too complicated to understand or too entrenched to change. The system changes constantly. It changed dramatically in 2017. It can change again, but it will not change in your direction unless enough people understand clearly what is happening and demand something different. Most tax policy debates in the media get framed in ways that obscure who actually benefits. Read past the headlines. Look at who is funding the research, who is lobbying for the position, and who ends up with more money when the policy passes. Third, talk about money. Talk about it openly. We explored this idea from the employment side, how workers are culturally conditioned not to discuss their wages, and that silence protects the people benefiting from the inequality. The same dynamic exists with taxes. People do not talk about what they pay, what strategies they use, what breaks they get or do not get. That silence serves the status quo. The more you understand the landscape and share that understanding, the harder it becomes to maintain a system built on most people not quite knowing how it works. The tax system is one of the most powerful wealth redistribution tools ever created, and right now it is redistributing wealth upward. Not because that is the only way it could work, not because the laws of economics demand it, but because of choices made deliberately by people with the resources and access to shape those choices in their favor. You are not imagining the treadmill. You are not failing to work hard enough. You are operating in a system that was engineered before you showed up, with rules that were not written with your financial future in mind. Knowing that is the first step. Understanding exactly how it works is the second, and demanding it looks different is the third. Share this with someone who needs to hear it. Drop your reaction in the comments below. Because the one thing this system was definitely not built to survive is all of us paying attention at the same time.